When a government or a company needs a large sum of money, they don't always go to a bank. Sometimes you become the bank. That's the idea behind a bond. It's one of the oldest tools in finance, and it's how some of the biggest projects in the world, from highways to hospitals, actually get funded. Today, we're defining what a bond is, and more importantly, why it exists. A bond is a loan, just not the kind you get from a bank. Instead, an investor lends money directly to a borrower, usually a corporation or a government. In return, the borrower promises two things: to pay the money back at a set future date and to pay interest along the way. Think of it like lending a friend money, except this friend gives you a written promise, with a schedule, for exactly when and how you'll get paid back. Governments issue bonds to fund things like infrastructure or public services without raising taxes overnight. Corporations issue bonds to expand operations, build new facilities, or fund large projects, without giving up ownership of the company, the way they would by selling shares. The bond lets them raise a large amount of money now and spread the repayment out over years, sometimes even decades. For the investor, a bond offers something different from owning a stake in a company. It offers a defined term and a defined interest payment, a predictable structure. That's why bonds are often called a fixed income instrument, the income being that steady interest paid over the life of the loan, and fixed referring to the agreed terms set at the start. At its core, a bond is simple. It's a loan, formalized, with a borrower, a lender, a timeline, and interest. That structure is what lets governments and companies fund big ideas using other people's money, one bond at a time. Now, what happens when the value being traded isn't money itself, but a bet on where prices are headed? That's where things get interesting. Next episode, we're defining derivatives. Subscribe to MoneyMind so you don't miss it.